Hello, everyone, and welcome to China Perspectives. My name is Jeremy Zook, Fitch's lead sovereign analyst for China, and your host for today's episode. Rising geopolitical uncertainty and competition are increasingly important factors influencing global trade and economic growth prospects. At the moment, the conflict between the US, Israel, and Iran is the predominant geopolitical risk with potentially significant implications for the global economy. In this episode of China Perspectives, however, we will take a deep dive into another region that has risen in geostrategic importance since the outset of the Trump administration last year. That is Latin America. The Trump administration has sought to reassert the long-standing Monroe Doctrine, seeking to maintain U.S. geopolitical primacy in the Western Hemisphere. And offsetting Chinese influence in the region has been a particular point of focus for U.S. policy. Today, we'll dig into the nature of the economic and investment relationship between China and Latin America to understand the degree of exposure between these economies and the risks that geopolitical competition could pose for these economic ties. We'll take a look at the exposure of Chinese corporates to Latin America and how their credit profiles could be impacted in the event that geopolitics disrupts the economic relationship more meaningfully. Fitch has just published two great special reports that examine these topics in depth, so I'm really excited for today's conversation. Joining me today are the authors of those special reports, Todd Martinez and Janice Chong. Todd is Fitch's co-head of the America's Sovereign Ratings team, and Janice is a group credit officer at Fitch focused on Asia-Pacific corporates. Welcome, Todd and Janice, and thanks for joining us today.
Thanks, Jeremy.
Thank you.
Todd, let's start with you on the macro side. A lot has been made recently of U.S.-China geopolitical jockeying in Latin America, and how the U.S.'s greater focus on the Western Hemisphere could hamper, or in the least shift, China's economic relationship with the region. To start the discussion, it may be most useful to just get an overview of what China's economic relationship with Latin American countries looks like from a very broad perspective. What are the key elements of this economic relationship, and how do we see some of the recent trends?
Yeah, thanks, Jeremy. I think it's good to start by taking stock of China's economic footprint in Latin America, because I think there is a perception that it's displaced the U.S. in its own backyard, but the reality is quite a bit more nuanced. So I think the big picture is that the China-Latin America relationship is still very much a trading relationship in both directions. China relies on the region for its commodities, and China relies on the region as a market for its own goods and services. And the flows are pretty big and growing in both directions. Exports to China are around 13% of the region's exports, or about 3% of GDP. That's double the level of a decade ago, and they almost entirely consist of commodities. So China has become the dominant trading partner for much of South America, where commodities are concentrated. And imports from China are around 22% of the region's imports and 5% of GDP, and that's up from 3.5% a decade ago. So there's booming imports of Chinese electric vehicles, solar panels, white goods like air conditioners, and the import exposure to China is very high in countries like Chile and Peru that have an FTA with China, but also in Mexico, which relies on China for a lot of components in its auto industry, and in Brazil and Argentina, which are closed. The imports from China are lower, but still pretty high. And I think China's importance as a trading partner is even more visible when you look at trade volumes instead of trade values, because values of exports and imports as a percent of GDP with China have flatlined over the past 5 years, but that's mainly a price effect. Some export prices like soy and iron have seen their prices fall, and a lot of Chinese manufactured goods have seen big falls in their prices. So that means on a volume basis, trade with China is booming by even more. And even though the China-Latin America relationship largely about trade, that doesn't just manifest in exports and imports. It also means Chinese investments are coming aimed at facilitating that trade. And the data's murkier here on FDI. Chinese FDI is still pretty modest in US dollar terms from the sources that report this. But it has been very important in some specific strategic sectors: commodity sectors, renewable energy, and infrastructure. And then last of all, in terms of financing and capital, China's not really a relevant actor here anymore. It used to be a major source of financing for sovereigns who were locked out of markets or had very expensive capital market access, like Venezuela and Ecuador. But those days are long over. And then Latin America's private sector has never really been very reliant on Chinese capital for financing. Chinese banks have a pretty small presence in the region. And there's only one company that we know of that's tapped the panda bond market. That's Suzano, a Brazilian pulp producer. So just to summarize, China's footprint in Latin America is big and growing in terms of trade. It's moderate in regard to FDI, but quite important in some certain sectors and pretty negligible in terms of capital flows.
Thanks, Todd. You bring up, of course, an interesting point on the broader financing from the government. That's something we see more broadly from China as well, that there's just been a retrenchment in some of that bilateral lending. You mentioned now that the economic relationship, of course, between China and Latin American countries, it's largely a trading relationship, as you say. What are kind of those key export sectors for Latin America, and in particular, what countries really have the largest exposures to China? And then, in the face of U.S. diplomatic pressure in the region and the steady growth slowdown that we've been seeing in China, how do we see the outlook for exports from the region to China?
Yeah, so it still really is all about commodities for China. About 75% of Chinese imports from Latin America are just five goods. First is copper, then there's soy, fuel, iron, and then meat. And then the other 25% consists mostly of other commodity items that are more niche, lithium, pulp, fruits, and vegetables. So that makes China the major export market for the region's commodity exporters. So it's the top export market for Brazil, Peru, Chile, Uruguay, and Bolivia, with 5 to 11% of those countries' GDP. And in Ecuador, it's not yet the top market, but it's been growing very rapidly since the signing of an FTA, and it's reached 5% of GDP in terms of Ecuadorian exports that go to China. And Colombia is an exception in South America. It is a commodity exporter, but its main commodity export is fuel, and China mostly sources that from its neighbors. And then in North America, Mexico and Central America, it's a pretty different story. Mexico produces sophisticated manufactured goods. Central America produces more basic manufactured goods. But China's a competitor in those areas, so it's not a very big market. And given how China's only importing commodities from the region, it might seem like it's not helping them rise up the value chain or not promoting economic development. But we think, even commodity exports have been very beneficial for these countries. And I think a great example is Ecuadorian shrimp. This might seem like a very niche thing, not relevant for a big macro picture, but Ecuadorian shrimp exports have skyrocketed to 8.4 billion in 2025. That's massive at about 7% of GDP. It's made it Ecuador's biggest export. And Chinese demand has been crucial for that. And it's been fantastic news for Ecuador's beleaguered economy. It's provided a much needed boost to real GDP, but maybe even more importantly, a big influx of FX inflows that's helped the country overcome some serious balance of payments problems. So you mentioned some of the risks, China's slowdown and US pressures. On China's slowdown, this has been happening for a while and it's not such a big drag on the region after all. Yes, the slump in Chinese investment has meant lower prices for goods that are important in civil construction like iron. But, Chinese consumption continues and consumption of food tends to be pretty stable. So that's good news for the region's agricultural producers. And China's export machine is growing strong. So that's great news for items that are needed in Chinese exports and in the energy transition like copper and lithium. And is US diplomatic pressure a risk? I think these countries have little incentive to pare back exports to China unless the US can come to the table as an alternative buyer. And that seems pretty unlikely. And in a lot of these reciprocal trade deals that the US is signing with countries in the region, there are these vague commitments to prioritize trade with the US, but nothing concrete in the way of needing to send less to China. So we think this US pressure is probably going to be more consequential in other areas rather than exports.
If we kind of look at the other side of the equation and the import outlook for Latin America, of course, China's exports themselves have continued to boom over the past year despite U.S. tariffs. We just saw in the latest January and February trade numbers from China, exports grew to over 20% year over year. And a lot of that has been because Chinese exporters are finding alternative export destinations, including to Latin America. But of course, that has implications for a lot of these Latin American countries as well. I mean, how are these governments responding to this large surge in Chinese exports to the region? And we've seen, of course, a number of countries impose tariffs on certain imports from China, including in the EV sector. Do we kind of expect these types of trends to continue?
Yeah, there's definitely a boom in Latin America in terms of imports from China, and two factors driving it. China's struggles with industrial oversupply and involution, this competition between companies that's lowering prices, is leading them to look for alternative markets. And then these trade restrictions from the US are also leading them to look for alternative markets. And Latin America is a great candidate. It has solid labor markets. It has a pretty strong middle class that likes to consume more than save. So it's kind of inevitable that there's been a big boom in Latin America. And over the past decade, I think it's been about 7% average growth in imports from China per year. But in 2025, that grew to 10%. And as I mentioned earlier, I think these numbers understate the boom in Chinese imports because a lot of Chinese goods are falling in price. So that means their growth in volume terms is even bigger. A good example is in Brazil last year, imports of cars from China rose 5% in US dollar terms. Doesn't seem like a lot, but they rose 35% in volume terms, which obviously highlights a fall in prices. So there's been some clear benefits for this for Latin America. The inflow of cheap Chinese good has been good for inflation dynamics, and it's helping households' pocketbooks. The president of Brazil's central bank even said China is exporting disinflation or deflation to the rest of the world. But it's also a problem, namely for the region's large economies that have more developed industrial bases that they want to protect. Many firms in the region have struggled to compete with cheap Chinese goods. And in Brazil, this competition's even been a contributing factor to a few cases of corporate distress. Petrochemical producer Braskem and the steelmaker CSN have both faced some recent financial distress. So a few of these countries are taking action. Brazil imposed a 35% tariff on EVs. Mexico imposing tariffs on many different goods with countries with which it doesn't have an FTA. Lots of countries trying to end these de minimis exemptions on e-commerce that mainly affect clothing companies like Shein and Temu. And this might be helping them achieve some of their aims, but kind of has the averse effect of potentially compounding inefficiencies in the corporate sector. Latin America does not have a great experience with import substitution industrialization, so there's a similar risk this time. And it could compound inflation pressures and affordability concerns. Even economies that are doing well and labor markets are strong, affordability is still an issue. And then on US pressure, so far not clear that the US pressure is going to lead countries to shun Chinese exports. In fact, the countries with the biggest growth in Chinese exports last year were ones most aligned with the US. Ecuador, El Salvador, and Argentina saw Chinese imports grow by 30 to 60% even. And in the reciprocal trade agreements with those countries, they didn't explicitly ask them to hike tariffs on Chinese goods or anything. But I think this will be an area we need to watch.
Janice, I'd like to bring you into the conversation now and get your perspective on how Chinese corporate, as Todd mentioned, there are some growing risks that there could be higher tariffs on Chinese exports to Latin America. How are Chinese corporates positioning themselves to manage those risks?
Thanks, Jeremy. I think to manage higher tariff risk, Chinese corporates are localizing production. They are setting up manufacturing hubs like EV assembly in Brazil, while investing in regional logistics and port infrastructure to keep trade flowing. They are also forging deeper infrastructure partnerships to tap into Latin America's growing demand. While the region is a smaller trading partner for China compared to ASEAN, the EU, or the US, it is an important growth outlet for China's excess industrial capacity, especially given China's commodity driven trade ties with countries like Brazil, Chile, and Peru.
Maybe we'll build off of that discussion on some of the localization trends. Turning to kind of the FDI story, outbound FDI from China has accelerated over the past several years. And yeah, I think this reflects some of those concerns around tariffs and, just the effort to diversify supply chains more broadly. From a macro perspective, Todd, are these flows of FDI, are they significant for Latin American countries, and particularly in terms of creating kind of growth opportunities for the region and then integrating Latin America more deeply into Chinese supply chains?
Yeah, so the first thing I'd say here is that in regard to FDI, there's a lot of issues with the data. Trade data is fantastically detailed, but FDI has a lot of issues and lags. For example, China reports FDI into other countries, but that can differ a lot from what those receiving countries are reporting. And a lot of FDI goes through offshore financial centers. So it's really hard to know how much China is really investing in every country. Only Brazil's central bank has done some good work in trying to find FDI on a final beneficiary basis of where it's originally coming from. There's other private sources that track FDI from the American Enterprise Institute, Inter-American Dialogue, Mexico's UNAM. They provide a more granular picture on specific projects, but focusing more on greenfield rather than brownfield, and they might miss the reinvested earnings that are included in FDI. But considering all these sources, the picture that emerges is that Chinese FDI into the region is pretty moderate, and it's actually slowed somewhat relative to the past decade. Brazil's data show Chinese FDI of 40 billion US dollars in 2024. That's 2% of GDP, and that's much lower than the 232 billion from the US. Private sources show a similar thing in other countries. And data on BRI investments show that Latin America is actually the region with the lowest Chinese engagement as part of BRI, well behind Africa, Middle East, Central Asia, and Southeast Asia. But looking deeper in the data, China has been very consequential in some specific sectors. Brazil's data shows that has the largest stake in the country's electricity sector, the second biggest stake in the extractive sectors, and the private sectors show a similar story: big investments in metals and mining, infrastructure, and renewable energy. So while Chinese FDI in Latin America isn't massive, and it's probably not integrating Latin America into supply chains very quickly, it's been very high impact, and it has some important spillovers. Renewable energy obviously has very consequential spillovers, helping countries grow and manage the energy transition and mitigate climate risk. And infrastructure investment, obviously very consequential as well. The Chancay port in Peru is perhaps the best example. So yeah, that's the summary. Chinese investment, not huge in the numbers that are available, but quite consequential in some strategic sectors.
Thanks. And Janice, what are the key sectors where we see the most concentrated Chinese FDI into LatAm? And are there any indications that we see that, there are other sectors that could become more significant players in coming years? And then, what's really driving this Chinese FDI into Latin America?
Yeah, the Chinese FDI in Latin America is heavily concentrated in mining and energy. So think utilities, oil and gas, and especially critical minerals. So over the last 5 years, these sectors have attracted more than two-thirds of Chinese FDI, reflecting China's strategic push to secure essential resources for technology supply chains and energy transition. So, for example, China is the global leader in lithium refining, but relies on South America for most of its raw material needs to meet its high demand for EV battery production. So we're also seeing the auto sector pick up steam. Chinese investment jumped nearly 40% from 2020 to 2024 versus the previous 5 year period, but still relatively small compared to the mining and energy sectors. So beyond raw materials, I would say Chinese firms, predominantly state-owned, are investing in logistics and port infrastructure to move commodities efficiently and in renewables to power their operations. Looking ahead, we expect Chinese FDI in Latin America to remain steady and targeted as Chinese corporates mature and China's slower domestic growth encourages outbound investments. The key drivers? Well, securing critical minerals, supporting global supply chains, and tapping into Latin America's growth potential, I would say that those are the key drivers.
Thanks. And given, as we've been discussing, this rising U.S. focus on Latin America, in part to counter China's influence, how significant do we think the risks are to Chinese corporate investments in the region, particularly in these very strategic sectors? And then would there be any potential rating implications for these Chinese firms if they were to see significant restrictions on their activities in the region?
Most Fitch rated Chinese corporates with direct exposure to Latin America are concentrated in utilities, chemicals, and food supply. So, in terms of direct risk, the impact is fairly limited. Latin America accounts for a modest share of revenues, and much of the exposure is in government related entities whose ratings are anchored by expected sovereign support. So, what this means is the Latin America specific developments alone are unlikely to drive near term rating actions. That said, there are indirect risk transmission channels to watch. Risks are more likely to come through commodity price volatility, trade flow disruptions, regulatory changes, or project execution challenges that could affect strategic assets like ports, electricity networks, and mining or infrastructure projects. These indirect factors could have broader macro implications, but direct rating pressure remain contained for now.
Thanks, Janice. And Todd, just to wrap up the conversation, it'd be great to dive briefly into some of the implications that geostrategic competition has for Latin America itself. I mean, is this likely to provide more opportunities or risks for the region?
Yeah, I think this is the question that inspired this special report and podcast. Latin America has been thrust into the geopolitical spotlight, and that's bound to have some economic consequences. It's just hard to know if they're positive or negative at this time. We see both risks and opportunities. I think on the downside, there will be risk for the region to the extent that US attention scares away Chinese investments that could be beneficial. And on the upside, there could be opportunities to the extent that the US seeks to secure its interests by coming to the table with its own investments and financing. And it's going to depend on how much the US relies on carrots versus sticks. The US has been imposing tariffs on some countries to secure non trade related goals. It's been removing visas for individuals seen as critical of the US or too close to China. It got rid of USAID, which was a source of economic aid to the region. And then there have been some carrots, probably fewer, but some examples are reciprocal trade deals with like minded governments. And then this $20 billion US swap line for Argentina that was quite consequential. So I think a few flashpoints are emerging in this geopolitical theater. Panama, amid US pressure, Panama left the BRI and it invalidated some ports concessions to a Hong Kong based firm. China's saying it's going to instruct its companies to avoid new investments in Panama, and that state shipping company Costco is going to avoid those ports. In Peru, the US has been very critical of the Chancay port. Doesn't seem to be pushing for Peru to nationalize it, but US says it'll build a military base nearby. And then in Chile, US pressure is leading to shelving of this undersea fiber optic cable with China, leaving a dilemma for their new president. So none of these cases involve dire economic consequences for these countries. No major disruptions to activity, no big investments underway are getting halted. But we think they could be an opportunity cost for new projects if they scare away Chinese companies who sense higher political risk, or they, lead countries to try to shun Chinese investments. And what about the upside? Is the US going to come to the table with new investments? I think the issue here is that China has an advantage relative to the US in terms of economic diplomacy because it's a centralized government that has big SOEs all aligned around a common agenda. But that's not the case in the US. The US doesn't have SOEs, and to unleash a wave of strategic investment in the region, it's going to need to work with the private sector. So not clear yet if that's going to happen, but two great things to watch, I think, will be let's see what happens with the DFC, the Development Finance Corporation. This is intended to be kind of a counter to China's BRI initiative. So we'll see if it can be expanded or used more effectively to help fund investments in the region in line with American interests. And then let's see what happens specifically with rare earths. China has a near monopoly on these resources. US is keen to develop them elsewhere, and Brazil has these resources. So a big opportunity here. So I think this will be a good test case to see if the US strategic interest in the region will translate into real concrete projects.
Well, thank you, Todd and Janice, again for your time and your insights today. Geostrategic competition is, of course, only likely to intensify in the coming years, so really understanding the nature and the depth of these economic linkages will be quite vital to understanding the overall economic impacts. I would encourage our listeners to take a look at the special reports, which were just published, and those can be found at fitchratings.com. That's it for today's episode. Thanks for listening, and take care until next time.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Subscribe to China Perspectives wherever you get your podcasts.